Hey everybody, and welcome back to the Teaching Tax Flow podcast. Today, episode 153. We are going to dive into those sometimes misunderstood qualified opportunity zone funds. But before we do that, as always, let's take a brief moment and thank our episode sponsor.
This podcast is brought to you by Strategic Associates. Are you a high-income earner, real estate investor, or successful entrepreneur who is frustrated by having to pay $75,000 or more of annual tax liability? If so, Strategic Associates can help. Your first step to saving thousands, if not hundreds of thousands, is to contact Roger Roundy at roger@strategicag.net or by calling 801-641-2956 and be sure to tell him TTF sent you.
Hey everybody, and welcome back to the Teaching Tax Flow podcast. Today, I'm going to say it because Chris has said it usually time and time again, I should say. We have a topic that we've mentioned very, very briefly, multiple times throughout the 150, 160 some episodes that we're up to. And we've never actually defined what this is, nor have we ever gone really into any detail on what it is, how to take advantage of it, how to not take advantage of it, specific things, and kind of doing a fence around this thing. So we're going to talk around the topic. I'm not going to tell you what it is because, as I always like to say, you can read it in the title, read it in the show notes. Don't be lazy. It's everywhere. You don't need to hear it again. Chris Picciurro, welcome back to your own show, man. And you can introduce our guest as always. You find these great people to join us, and it makes me feel really dumb because I'm always the dumbest guy in the room when we talk about this stuff. But then you bring a guest in, and it really knocks me down a peg, and I'm okay with that. I should say.
John, it's great to be back. I'm very excited about our special guest on this week's episode. I had a friend introduced me to this guest, so I can't take full credit for this. However, John, I'm still impressed with your mentioning of depreciation recapture a few weeks ago. I'm floored that you even have that terminology in your personal dictionary. So I'm pretty proud of you still. So
sometimes
congratulations.
Being a marketing guy, there's not a whole lot of extra space up here in the dome. But the little room that there is, sometimes, I can extrapolate something. So, and I got to give you credit for it. I learned it from you at some point in the 20 some odd years. So,
or editing all these podcasts, maybe.
Or that. I'm tired of hearing your voice, man. This is what I love guests. I hear less of you.
We're excited.
So
we're excited about our guests today. And one of the things we have to understand, and then we're going to dive into it. One of the 3 laws of teaching tax flow, one of our 3 laws of tax planning, that the tax agencies are our involuntary business partner, and tax laws are written to encourage and discourage certain economic, social, whatever behavior. We also know that tax-free income and growth is a very powerful tool. A lot of times when people think about tax planning and strategy, they're thinking about, what could I do to reduce my tax today? But there are some strategies that not only could potentially defer your tax from today, red diagnosis, but give you tax-free income and growth. And that's very, very powerful. One of those strategies that is a hybrid strategy, so hits on multiple different tax benefits or diagnoses, are qualified opportunity zone funds. And we're going to talk about that because one of the things I see in the private CPA practice and in our teaching tax flow community is that there's a misconception that if you purchase a piece of real estate that happens to be in an opportunity zone, you get some type of tax benefit. And that's not necessarily the case. So I'm excited. We're going to welcome Jessica Correnti from Capital Square. Jessica, welcome to our podcast, and thank you so much for joining us.
Thanks so much for having me. I'm honored for the opportunity to speak with you both. I'm really impressed with the other sessions that you've had. Took some time to listen, so I'm excited to be on here today. Thank you.
We're excited that you showed up if you've listened to the other ones. So, congratulations to you.
Sure. I had a window free up today.
There you go.
We appreciate it. Before we jump in, can you tell us a little bit about yourself and how you found your way into finances, Capital Square? We know that I think you are in the city of brotherly love right now, but how did you find your way there?
Sure. The quick version is I started with a printed out resume that I handed to the front desk at Morgan Stanley office in New York and asked for a job. Fortunately, whatever they read or however I put it was good enough for them to invite me to come in and start working at Morgan Stanley. Switched over to the sponsor side. The private real estate, private equity people always caught my attention and wanted to be a part of something where I could grow in my career. And I thought that was a great space to be in. Fast forward about 13 years, I'm head of distribution national accounts at Capital Square, helping all advisors across the nation understand how powerful these tax advantaged real estate solutions can really be, especially opportunity zones.
Gotcha. So yeah, there are we talk about that certain industries do have tax favoritism in the tax code. Real estate's one of them. Opportunity zone funds are part of that tax advantage. So that's cool. That is really cool. And did you grow up in the Philadelphia area or did you migrate
Grew up
there?
grew up in New York, and then I broke the cardinal rule, broke my parents' hearts, and moved to New Jersey. So, we're out here now, Philadelphia Eagles fans. The Jets are near and dear to my father's heart. Um, but we'll be ruining Super Bowls over here. How are you guys doing?
Yeah, so we're good. No, I understand. I grew up in Detroit. I've been in Nashville with my family for about a little over 9 years and became Lions free many, many years ago when Barry Sanders retired. So when we moved here, our kids were so young. They're 16, 15, and 12 now. We adopted the Titans, and they're just about as bad as they are at the time of this recording. So it was pretty, there's a lot of room on that bandwagon for anyone that wanted to be a Titans fan. We've ridden a pretty good ride. They had a good run for a while, but all my other teams, I went to Michigan State. I'm a big Detroit Tiger fan. Like those teams are still a part of me. And I know John, he's not he understands hockey pretty well, and I know he's a big Red Wing fan.
Yeah. It basically it takes a specific person, as my friends say, to voluntarily take a puck to the head, being an ice hockey goalie for 16 years. So maybe that's why my personality is a little off sometimes, Chris. I don't know. We'll figure it out. But
Well, you know what's not off? The tax benefits of qualified opportunity zone funds. And the cool thing with
that is the best
OB3
way, though, that you've ever reeled a topic back on schedule, sir. That was incredible.
well,
There you go.
hey, that it ties in.
Man.
So cool with opportunity zone funds. I know they came about during the Tax Cuts and Jobs Act of 2017. And for the purposes of this conversation, and I actually am stealing this from Jessica. I learned in when we chatted before, we're going to call that OZ 1.0. And then OB3. Oh, John, I'm so proud of you that you
I
put those. Yeah, though
It's
you put that
coming.
acronym jingle in. John created a little sound bite for any time we use a tax acronym like OB3. And it created tax, or Opportunity Zone Fund 2.0. And let's kind of talk through from a 30,000 foot view, just the tax benefits of Opportunity Zone funds, and then maybe jump into 1.0 versus 2.0.
Sure. And one note prior, if you have a tax acronym jingle, you should be able to sell that to any wholesaler, CPA, or advisor out there. That's a moneymaker opportunity.
We're gonna Chris being in Nashville, we're gonna catch him on the streets one day, and he'll like sing a little jingle for us.
Oh,
You
you
know,
don't
Yeah.
want that. No,
I'll get out a ukulele, and Chris will start singing. It'll be a hit amongst nobody. It'll be fantastic. But
But back to opportunity zones and how they can help an investor. The interesting thing about opportunity zones is any capital gain can be worked with an opportunity zone opportunity. Um, it could be a capital gain from stocks and bonds, how you might typically think. It can be a capital gain from the sale of real estate, but it could also be a capital gain from the sale of a business, sale of art, crypto, or Bitcoin, and it can be a short-term or long-term capital gain. So if you have literally any scenario where there's any capital gain, you might have an opportunity to work with your advisor for an opportunity zone offering. In Opportunity Zones 1.0, so speaking of the people today, because there's no reason to speak of the past, today you have the ability to invest that capital gain in a qualified fund and defer your tax due on that gain until the tax year for 2026, so payable about April 2027. In the meantime, your investment in that qualified fund can grow tax-free for 10 years at a minimum. So it's a very powerful tool to get tax-free growth and defer taxes for a little while.
And Jessica, you made a great point. A lot of times people are very hung up on 1031 exchanges, and we are advocates of 1031. I've used 1031 in my personal life. However, it's very restrictive. And the cool thing about opportunity zone fund investments is that you nailed it. It could just be your capital gain. It could be a portion of your capital gain, right? It could be any capital gain, and you don't have to use a qualified intermediary. So a lot of times these capital gains are actually straddling a year. And I've had several situations in our private CPA practice where someone may have had a capital gain, a large gain, let's say December 20th. And we're looking at potentially making a tax extension payment. Most of our clients do tax extensions in April 15th, and we're saying, okay, you're going to owe X amount of dollars. Oh, I wish I could have done something. You still can. What are some of the rules as far as how long do you have from that time you have your capital gain to deploy that into an opportunity zone fund?
You have 180 days to deploy, and to your point with 1031s, there is no restrictive ID window or anything like that with the qualified opportunity zone. I find often, and maybe this is a similar example to what you're giving, people's exchanges will not work out, and they're at day 47. Oh, what do? We have to pay the tax. No, you don't. Use a qualified opportunity zone fund.
Right. Absolutely. So it's a remedy, and a lot of times it allows them, if they started a 1031, they opened it up with a QI, they cancel it. They're surprised to realize, wait, I might have $500,000 in my pocket, but my capital gain was really only 300,000. I can keep 200 in my pocket and deploy the 300. So to me, the ultimate flexibility here, in so fact that you can, all are part of your gain. And then I believe I shouldn't be trying to remember this on a live feed or a live recording, but I'm pretty certain that you get the 180 days from the time you're aware of the gain. So for instance, let's say I am a partner in a partnership and I own a sliver in an apartment building. That apartment building might have gotten sold and I may not have even known, because maybe there's a bunch of apartment buildings. Chances are I might have an idea. I actually get the 180 days from the time I get my K1 so sometimes it could be beyond 180 days into the tax years, was my point.
Absolutely. So for the tax due date of April 27, if you're a partnership, you might have a delay, an extended period of time where you'll be paying that tax bill.
Yeah. So that is that. So there's a lot of flexibility on OZ Fund 1.0. And then if you keep it for 10 years, then you could get some tax-free tax-free growth.
Tax-free growth. Yep.
Wow. So anything else on Tax Pro or Tax Pro? OZ 1.0, or we can call it OZOG.
OZ. I love that.
Now we need like a rap jingle going on
It
there.
helps with all the numbers and yeah. OZ 1.0. So let's say the very top number one tax incentive is the tax-free growth, of course, over a 10-year period. I would argue more than the deferral into 2027, that the next largest benefit of the 1.0 program is the potential to eliminate a portion of what you're going to owe in 2027 through the fair market value provision in the tax code for opportunity zones. Simple way to put it, you are allowed to recognize for your tax purposes the fair market value of the investment as of December 31st, 2026, or the amount of your gain less your basis. So if you have a fund or you're invested in something where they provide a new value and the value is less than your gain, you're now paying even less in your taxes come 2027.
That's a great point, because and that's a fear of many people thinking about a qualified opportunity zone fund. Man, I've got a $50,000 gain, but I really only have, for lack of a better term, $40,000 of equity or $40,000 of fair market value. I paid tax on too much. And ultimately, I think it's very fair. No pun intended. So that's a great benefit. And that snapshot's December 31st, 2026, correct? That's when that fair market value would be assessed.
Exactly. So it'll be whatever the fair market value is as of that date. Correct. So if you
Awesome.
have a value that's struck in November of 2026, as long as it doesn't change
Hmm.
by the end of the year, you're good.
Wow. So I'm going to move on to OZ 2.0. Maybe we'll call it OZ Senior, and we got OZ Junior. But I think, um,
I like the
this-
OG one.
yeah, we're going OG. We're going to go OG and 2.0. So for 2.0, doesn't come into play, until 2027, gains in January 1st, 2027, or into the future. But what are some of the things that the One Big Beautiful Bill stated with the Opportunity Zone funds? Because they were going to be gone basically if they weren't put into the act.
Yeah, and frankly, a lot of people I've been speaking to who are on the advisor side of the business didn't bother to learn about opportunity zones because they were not permanent. So I'd say that the what we should be celebrating the most with 2.0 and OB3 is the fact that opportunity zones are now permanent, which really shouldn't be a surprise. It's been arguably the most effective piece of tax legislation in the history of our nation, um, for both the tax benefit and the impact in communities.
I could tell you the impact in communities I mean, in Nashville, there's an area called the Gulch that used to be, when we moved here about 10 years ago, was quote unquote an up and coming area. And it's beautiful. There's areas we went to Atlanta for my son's baseball tournament, Buckhead. There are areas that were Opportunity Zone funds that look great now. So, I feel like it has helped with economic development of certain areas, job creation, and all that stuff. So making it permanent does give it a sense of not just permanency, but legitimacy as far as this is a strategy that we can use indefinitely and should be considered.
Yeah. Just at Capitol Square, in the projects that we've done, we have seen over $190 million of GDP created just from our projects in opportunity zones.
Wow.
So we love it from both the impact and from the benefit side. So I can definitely share some of the benefits that
Yes.
OZ 2.0 will have. Again, this is really looking and planning for 2 years ahead. This is not something you can act on today. 1.0 is where you're acting today.
Right.
For 2.0, you're still going to get that 10-year of tax-free growth benefit if you hold it for those 10 years. What you get in 2.0 is a 5-year deferral on your tax for your capital gain. So you're looking at a 10% increase in basis for a typical OZ project, or a 30% increase if you're at a rural opportunity zone fund, which a lot of speculation about what rural will be defined as. We'll find out probably towards the end of the year.
Gotcha. Yeah. And that's something that it was my understanding, and correct me if I'm wrong, but when they identified the opportunity zones for the TCJA or OG or 1.0, a lot of that was put on the states or the governors. And a lot of that, they went back to the 2010 census and identified areas that you wouldn't think were quote unquote needing of redevelopment. So it'll be interesting to see what is designated as an opportunity zone and what is a rural opportunity zone, or it'll just be really fun to see. As a tax professional, I love seeing that kind of stuff. And
I think it will be interesting to see a sponsor, like outside of just Capitol Square, come up with creative ways to put money efficiently to work.
Mhm.
You can't put a apartment building in the middle of a cornfield, right? You need to find something, be a little bit more
Right.
diligent about what you're investing in for 2.0.
And not talking about any specific funds or anything like that, but what are some of what activities you're seeing in opportunity zone funds? Obviously, real estate's big. What type of real estate, or what type of activities are you seeing that in your experience?
I've seen a lot of development of multifamily, some hospitality. Hospitality's been good because the zones, right, are typically where they're trying to drive revenue. So you'll think of tourism. Multifamily, of course, is housing shortage everywhere. Any person you ask in America will tell you. We're seeing businesses. You're able to invest in businesses for qualified opportunity zones. So you see some gold and things like that. It really runs the gamut. Some storage. Yeah.
Wow. And the yeah, I mean, the outlook is really good on this, right? Because it's but I think we got to focus now. If you're listening to this and in 1.0, and there's still opportunity, no pun intended, there, because even let's say you were to have a capital gain in November of 2025. To be able to defer your tax for almost a year and a half, plus the other step up in basis benefit you explained, gives you an extra year and a half to plan. So that's another factor also. So
Some
and
capital gains you can time, but some you can't. So what do you do today? Are you going to pay all your money to Uncle Sam, or are you going to find a solution? And 1.0 is still a very viable solution.
and I have one question, kind of a final question on that 10-year rule. With Can you explain that clock? In other words, does the 10-year start on the day of the capital gain, the day of the capital gain, day of the investment, the first tax year of the investment? How does that work?
So when you're investing in a qualified opportunity zone fund, the
Mhm,
fund has to hold the qualified investments
mhm.
for 10 years from the last dollar invested.
Okay. Gotcha. So there's some advantages of kind of being early into a fund. There's some advantages to being kind of at the tail end of it, depending on where you're at. Awesome. Anything else that you think I might have missed on? I'm looking at my notes, and one thing that just a thought as far as from a bigger picture with OB3, we thought there was potential that the capital gains rate might go back up and it's staying lower. But the fact that you have short-term capital gains eligible for OZ funds is very attractive, because a short-term gain could be a pretty high tax.
Yes, and if you think about what has happened in the market over the last year, especially, or even in just the crypto market in the last year, maybe you have NVIDIA positions, this might be a really strong opportunity to de-risk yourself a bit and diversify.
That's a great point. Well, we appreciate it. If someone has to someone wants to get a hold of you, and what's the best way for them to reach you?
Best email for me is sales@capitalsq.com. Otherwise, I'm on LinkedIn and always out and about at these different conferences and events. So thank you so much.
Well, thank you. We appreciate it. This has been amazing. I have been working in OZ funds for many years, and I learned a few things today, and I know our listeners are going to be very happy.
Great.
And Chris, you get
Hope they
another
all benefit.
Chris, you get another point on the board for another good guest. You haven't failed yet, so we're doing good here. But so I know we talked about this, and I'll wrap this up really quick. But as far as for this topic, right? I think now after this conversation, people have a pretty good grasp of where they stand right now, what these are. Is there anything specific, Jessica, that you may have if they have specific questions on this stuff? I mean, obviously they can reach out to you, they can connect with you, but are there any resources that you guys have maybe online or a newsletter or anything like that as well that somebody could get, kind of an ongoing support updates with this stuff?
1000%. If you went to capitalsquare.com, you'd be able to sign up for the newsletters and our equity updates. You'll be able to go to our Opportunity Zone Learning Center, where you'll find all of this information I've provided, some walkthrough brochures, videos, and of course, more contact information with the other sales team members at Capital Square.
Awesome. Perfect. Well, as Chris mentioned, thanks for joining us. Thanks for sticking it out with us. And obviously, thank you for showing up. Because like I said earlier, if you've listened to our stuff, we didn't scare you away. So you must have a strong personality, kind of like us.
I appreciate the opportunity. Thanks so much, guys.
Awesome, Jessica. And Chris, I guess I'll see you again next week. Same time, we'll do it again.
Sounds good.
All right, everybody. Well, thank you for joining us here on the Teaching Tax Flow podcast. We'll see you again next week, same day of the week, different date, completely different topic. Have a good week, everybody.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.